Thanks for joining us today on Market Call. I'm Morella Fernandez. Mike Philbrick on the show with us today. He's CEO of Resolve Asset Management. He'll take your questions on exchange-traded funds. Here's how to reach us. Call us toll-free at 1-855-326-6266. You can send us an email as well, marketcall@bnnbloomberg.ca. Mike, it's good to see you. Thanks for joining us today.
Always a pleasure. How you been doing?
I'm good. You've referred to investor sentiment at this time as fragile. How so?
Well, I think we've seen it in the markets with the jitteriness around what we're seeing on the U.S. markets, and really since the beginning of October. If you look at whether it's the TSX or the S&P, you see this nice, smooth upward trajectory, and then around the beginning of October, we've got a lot of volatility and not much progress. And, you know, what we're seeing is some brittle behavior with respect to what's going on in the AI world. You know, you can see it right there on the chart. You see this nice smooth line on the TSX. And then beginning in October, we have a little bit of confounding around, is the AI CapEx going to be rewarded? And now let's look at that. We've got a breakout to all-time highs in the TSX. And the CapEx is real. There's $350 billion in CapEx spent this year. Global AI spend is $1.5 trillion by year end. So the AI is not hype, it's real money. But what we have here is 1.5 billion users engaging with consumer tools around AI, but only 3% are paying for the premium services. So that's the gap between adoption, which is explosive, and monetization, which is lagging. And that's brought in this sort of week-to-week volatility. It's not the eventual effect of AI, it's the timeline with which the technology will manifest. That's probably the thing that's bringing in the fragility.
Then it sounds like, and I don't want to speak for you, in your opinion, the concern's unnecessary.
I'm not saying unnecessary. We really quite don't know. I think it's unnecessary, but it could take time for this to roll out. What we had is 81% of the S&P companies beat earnings expectations. So that tech lead beat is real. Really, it's this whole idea of, are we going to see this manifestation of AI being paid for by the consumer and by businesses? I think it is. There are some parts of the market where we're having a little bit of that bubblicious action, where if you look at Palantir, pretty expensive stock, lots of high hopes. But at the same time, you've got Warren Buffett taking a position in Google. So this is not a bubble by normal standards. You know, if we look back at the tech bubble, it was up 800% by the time that we had the popping of the bubble. I mean, we're up 100%. So I don't think it's bubblicious. I think we're just working through a natural progression where it's a bit uncertain as to what the adoption is going to be. Plus, we have, remember, we've talked about in the past that J curve of resource production to build the AI centers and to build the power generation required. So there's a couple of things where there's some uncertainty, and stocks are discounting mechanisms. So they're trying to discount a future of pretty massive growth, and very small changes in that will have larger impacts today. So this is why you just want to make sure you're sticking with some quality growth companies that have some pricing power. You've got some commodities and natural resource exposure to get that IA build out, get the atoms and the bricks and the shovels that actually build this AI build out and the grid expansion. And then, you know, for the uncertainty, make sure you have some gold and some high quality bonds in the portfolio as well. And to be fair, Canada is really well positioned here. Huge cross-border flows coming into Canada, both in bonds and stocks. And so, as we've talked about in the past, the TSX or the TSX mid caps, XMD is an ETF ticker there. You're seeing them really do well because of the industrials, the energy, and the materials, and the impact that they're going to have in the rollout of AI. Okay. So there are places to go.
There are places to go. We'll talk some more about that during the show. Mike Philbrick, Resolve Asset Management, on the show with us today, taking your questions on exchange-traded funds. Here's how to reach us. We're back with your phone calls and your emails in just a moment. Welcome back. We're going to start with an email today from Kevin, a question for Mike Philbrick. The question is, what are your thoughts on the BMO Banks ETF, ZEB, so the Canadian Banks ETF? Mike, what are your thoughts on this one?
Well, first of all, this is the equal weight exposure to Canadian banks, the big six Canadian banks in Canada. So they remain well capitalized, good, strong balance sheets. Earnings growth is still constrained a bit by, a little bit of loan demand issues and some higher credit provisions. But I think right now, on balance, this is a good place to be. Valuations are reasonable, dividends are strong, and we are expecting, a tailwind from rate cuts and rate cut expectations. So this is good for long-term income-oriented investors. And I think, Canadian banks being part of the Canadian market are going to benefit from those global flows that are hitting Canada, first in the bond market and then in the equity market. And we're seeing that sort of pervasive through the equity indices. And so I think banks are going to be taking advantage of the resource expansion that comes along with what's happening in AI adoption. So they're a great way to play the Canadian market and a nice core way, good valuations, good dividends.
Okay, good to know. Let's go to Joe on the line in Montreal. Hi, Joe. What's your question today?
Hi. I want to ask Mike about the Harvest Tech Achievers ETF, HTA. I've had it in my cash portfolio, also in my TFSA. For several years. It's down a bit this year, but it's overall still done quite well. And I want to ask Mike, because I'm trying to think about selling off some TELUS for the tax season. Would this particular ETF still have a lot of legs to run once the bubble is finished, or could he suggest another one? I'm looking for a tech ETF that has a covered call option, so I could get some growth. Some revenue while I'm waiting for some growth. I'm retired, and I appreciate his input. Thank you.
Okay, thank you for the question. Let's first just go through what would be included under the HTA ETF. I know it's 20 technology stocks, I guess, but if you could give us an idea of what's under that banner.
Yeah, I can. It's actively managed, and I'm going to just take a peek in the holdings. But on this one, it's not covered written. So I know the caller wanted a covered call strategy. Oh, wait, no, I'm sorry. It is covered written. So this enhances that monthly income for that on HTA. And it is actively managed as well. And so under the hood, you've got Apple, Alphabet, Arista Networks, Applied Materials, Broadcom, NVIDIA, Micron. So again, an equal weight portfolio. So you're not taking too much individual stock risk. And so I think this is actually, for what you're looking for, it's not bad. You could make a lateral transition, but I'm not sure that you're going to achieve much more moving out of this. I will say you are taking a significant bet on technology and that AI rollout. And so it may behoove you to think about other areas of the market that are ancillary to this, whether you're thinking about something in the energy area with some covered writing on it. ENCC at Horizons has something. So you're looking at what's going to the energy that's going to be required for this type of thing. Those types of ancillary benefits. But I think this is pretty good. I mean, you could make a change and look into the CI Tech Giants covered call ETF. But, really, even though that's got a slightly smaller MER, I'm not sure, once you sell one and buy the other, you're really getting a very similar basket of securities. So I think you're okay where you are.
Okay, Joe, I hope that works for you or gives you something to consider. Let's move on to the next caller. Jay is in Bowmanville, Ontario with his question. Hi, Jay.
Hi, Morella. Hi, Mike. I'm a senior. I'm looking at ETFs that would come under the alternative or fixed income area. I have right now Happy Tea from Harvest, which basically is a covered call on the 20-year Treasury, which hasn't done great as as you know. So I'm looking at something that doesn't focus on treasuries, an alternative that would give me anywhere in that 7 or 8% range paid monthly. Can you suggest something, Mike? Thank you.
Thank you for that question. So a fixed income ETF, 7 to 8% yield.
Yeah, and so the covered writing on the treasuries is an interesting one. I'm not a huge fan of that particular approach, only because you're largely buying bonds for some sort of safety in the portfolio, and they also act as a counterweight during growth shocks. So typically, when you get some sort of growth shock, earnings shock, stocks go down, and bonds tend to go up. And the more sovereign or the higher they are in the capital structure, like government bonds, they do better. But when you're covered writing bonds, especially government bonds and long-term government bonds, you lose that upside because you're trying to get some income from it. So that combination to me is a bit antithetical. And so I would sort of suggest having the government bonds in your portfolio and taking the income, not covered writing them. We've got a top pick coming on that. If you want to stay sort of, a little shorter, you could go XSB. You've got ZGB, which is the BMO government bond index as well. Again, the yields are in the 3% range, though, so it becomes more difficult. And so I think you might be trying to find something that doesn't exist. Now, as something that's a little bit different, if you're willing to consider U.S. dollar exposure, RSBA is the return stacked bonds and merger ARB portfolio, and that stacks the merger ARB risk premium on top of government bonds rather than the credit premium. So oftentimes you'll reach for a little bit of extra yield going with top rated credit instruments. But those credit spreads are very tight today, and credit is actually correlated to equity markets. So when you have an equity market decline, oftentimes the credit exposure expands, making your bonds go down a bit, which is kind of correlated. With RSBA, the merger ARB, bonds and merger ARB ETF, what you have is those U.S. bonds. This is a U.S. dollar product, but the merger ARB is stacked on top, and that is not correlated to equity markets. So have a look at that ETF and see if that might be a fit for you.
RSBA is the one you recommended.
Yes, and to be clear, we do manage that ETF. It trades in the U.S.
Okay.
So it's a U.S. dollar ETF. I'm not sure if that perfectly fits for the caller.
Got it. All right, we're going to take a quick break. Back with Mike Philbrick of Resolve Asset Management. He's answering your questions today on exchange-traded funds. Back in a moment. Welcome back to Market Call. Thanks for joining us today. Let's go to Dave. He's got a question for Mike Philbrick. Dave's in St. John's, Newfoundland. Hi, Dave.
Hi, Marla. Thanks very much. Mike, I have a sensible portion of my holdings in crypto ETFs. I own ETHX, BTCC, and SOLQ. And what I was wondering was, do you think it's a good idea to keep holding some, none of them, or all of them? Love to hear your thoughts. Thanks very much.
Thanks for the question, Dave. What is your take on sort of how many of the crypto ETF space you should or could own?
I think that, again, digital assets are something that has a high volatility. So when something has a high volatility, what you want to do is just make sure your position sizing is correct. So own a little bit less so that the maniac doesn't run the asylum, if you will. You don't want a lot of these in your portfolio because they're going to whip the portfolio around. But having some small exposure in your portfolio has the opportunity to add diversification as well as adding significant asymmetric upside. So what we have at the moment is whether it's Bitcoin. So the caller mentioned 3 ETFs, one representing Bitcoin, one representing Ethereum, and one representing Solana. And they all have slightly different use cases. Bitcoin is like the digital gold, if you will. It's the base layer and infrastructure of having a limited scarce asset. And so scarce assets are great because they're like gold. They can't be printed out of thin air. You must buy it from somebody who already owns it. I think that's a wonderful holding in your portfolio. Ethereum is more like call it the copper, the oil. It's a smart contract. It's a layer one level. And this is where we're hearing things about real world asset tokenization, as well as stable coins. The Genius Act and the Clarity Act in the United States have set the legislation in place, as well as the SEC acts around clarifying all of the crypto space and its ownership and its regulatory issues, all have been cleared. And so Ethereum and Solana are representing those transactions that will happen on the blockchain to make things easier. If you want to transfer money today and you want to do it on a Saturday, it can't be done. Whereas it can be done on the Ethereum network, it can be done on the Solana network. So they serve a slightly different purpose. And as we tokenize assets, and we will tokenize these assets because it is a better, cheaper, and faster way to transact and settle transactions, you're going to see extreme growth in this area. So I think all three of these are wonderful. And I think that's a pretty good thing to continue to hold. The volatility will be large, but the payoff is potentially large. So make sure you size it right. You don't need a lot. Just a little bit of salt makes the dish much better. So a little bit in your portfolio will improve things pretty nicely, I think.
A little bit of salt. Bubblicious was the other one I have a takeaway from you today, Mike. Let's get to George. He wrote an email and he says, I'd like to have your thoughts on XRP.to, and do you own it? Would you hold it inside of a registered account? Tell me about XRP.
So XRP is another digital currency. This is Ripple. And Ripple has a very specific use case. Again, highly volatile. But unlike Bitcoin or Ethereum, XRP's use case is very narrow, and it's an institution-specific use case for cross-border flows and cross-border liquidity cycles. And so it does have a use case. It is different than the other three we talked about, Ethereum, Solana, and Bitcoin. Personally, I do not own this, okay? But I think it's a wonderful use case. And again, in the right amount, I wouldn't be trying to really guess at which one is going to be the category killer. I think across the board, we're going to see things, ebb and flow. But Ripple's payment networks are compelling for those cross-border international flows.
Okay, let's move on then back to the phone lines. Barry is in the line in Oshawa, Ontario. Hi, Barry.
Hello. I'm calling Mike about cash. I've been trying to sort of build up my cash in my account to wait for a better day, maybe when things are a little cheaper. I have quite a bit in ZMMK. My Canadian money is in that, and I believe that, Mike, you've recommended that. The problem I have is with my U.S. cash. I don't want to move it back and forth because I think the bank makes a little bit of money off of that when that happens. And so I have some in HBIL.U, which is sort of a covered call type strategy that pays a nice 7% return, but the share price continues to fall, so it seems like a loss. Do you know what a good U.S. cash ETF might be?
Okay, thank you for the question, Barry. Mike, a good U.S. ETF?
Yes, I do. Horizons has one, and I'm just trying to look it up. I think they have a Horizons has a T-bill ETF, and let me just see if I can find it.
You don't remember what it's called?
I'm looking it up.
Okay.
So it's the Global X 0 to 3 month US T-bill ETF. It's ubil.u. ubil.u. So this is the Global X 3 month US T-bill ETF. Currently, the distribution's around 4%. And so that will actually do exactly what the caller wants. It keeps it in US dollars. And he is correct. Every time you do a change back and forth, CAD USD, you are paying a little vig to everybody. So if you can maintain your US dollars in something like this, and this is about as rock solid as it gets. So it is literally 1 to 3 month T-bills, US T-bills, and that should solve the problem.
Okay, let's take a quick break. When we come back, we will have a look at Mike's past picks. That's coming up next. Time now for a look at past picks from Mike Philbrick. We're going to start with Global X Gold covered call ETF, GLCC on the TSX, and these are from January 21st of this year. It was recommended, Mike, at the time at 28.49. Now it's up to 54.72, so a 92% return, a total return of over 100%. Gold obviously has had a pretty banner year, and this would have benefited from this. Did you trim this at all? Have you held on to it? What are you doing with Global X Gold?
We've trimmed it. Anytime something goes up by 100%, you're going to be trimming it into the portfolio. But I think it still should be a good piece of a portfolio. So if it was 10% of the portfolio is growing to 20%, you're going to have to trim that back a little bit. And this is just, this is gold miners with covered call income, but it stems from the fact that gold is an asset that is scarce. And over the last few years, what we've seen is sovereign central banks and areas of the world start to understand that, when Russia invaded the Ukraine, there was a confiscation of Russian assets in those treasury bills. And that was a watershed moment. That hadn't happened since World War II in Germany in any significant way. And that caused nations to look at their holdings and say, well, those aren't so sovereign anymore. And they started buying gold. And so for the last 4 years, those sovereign nations have bought 1,000 tons of gold per year. That bid is still in the market. And those nations are looking at two things. One is their sovereign reserves and where are they and how could they be confiscated? The other is that we've got this constant debasement theme that's going on. Budget deficits are still 7% over what income is. And so there will be this consistent debasement of the US dollar. And so that's what's going on under the surface for gold. Gold miners are a proxy investment with a little bit of leverage because they're companies investing in that. So they give a little bit more upside. And the nice thing is with the covered call, you can get that nice income. I think particularly at this moment, while we're in this consolidation time for gold, it's great to have this income coming in. And you can see, as the chart points out, since sort of mid-October, it's been a little bit more bumpy. And I wouldn't expect that to change. I think gold is something you want in your portfolio, and it will go through these fits of, look at the return since August. You had this huge run up. You're going to have some consolidations. Nice to get those incomes coming in. Remember that covered writing does limit some of the upside, but you do get the income. So having some other ETFs like maybe ZGD or GDX, where you're owning the actual gold without covered writing it, as well as owning some covered written, that combination also makes sense. Or even some of the gold underlying like a GLD.
Okay, let's get to your next past pick from January. BMO's Equal Weight U.S. Banks Index ETF, so ZBK on the TSX, 39.82 at the start of the year, and now to 40.40, so 1% return and 3% total return. First of all, what are your thoughts on sort of where American banking is right now, where financials are, and is this something you would invest in today?
Yeah, I think that area of the market is actually pretty good. It's supported by some strong capital ratios and a pretty resilient consumer. The yield curve is slowly steepening, so that should help as well. And in this particular ETF, it's an equal weight ETF, so you avoid that over-reliance on the mega cap banks. So I think, loan growth has been modest, but buybacks are returning. So I think actually this is something you want to continue to own. Cyclical exposure to U.S. financial strength without a single name risk. I think that's the theme. At this point, it looks like we're just a little bit early, but that's why you put several things in the portfolio. I think this is due to have a banner year coming up, and will benefit from a lot of the technological innovations that's coming from the blockchain will benefit U.S. banks.
Okay, let's get to your third pick then. Roundhill Magnificent 7 ETF, so MAGS, M-A-G-S. Let's take a look at what it was when you chose it. It was 55.59, so this is U.S., and now up to 66.31, and it's a 19% upside and then a 19% total return as well. This is the Magnificent 7 companies, the big tech companies, and exposure to that. Is this one you still like?
Yes, but it comes back to what we talked about at the top of the show. So while I like this, and what this does is it really allows you to focus in on that really large AI theme. It's Apple, it's Microsoft, it's Google, Amazon, Meta, NVIDIA, and Tesla. And so I do like it. I think that, there's some volatility happening there. And as we talked about you're seeing a little bit of rotation out of these mega cap tech stocks. So I do think there's still a position in your portfolio for this. And again, it's going to be a smaller weight. It's something where, these stocks are all obviously in the S&P 500. They're cap-weighted stocks. You get a lot of exposure. So if you want a little bit more, you're looking for a little bit extra exposure, this is an easy way to do it. And it's exposure to that AI infrastructure, chips, cloud, device, software, all of those things. And, we do have higher valuations, and it's a bit of a mixed bag. You've got Apple and Google, and as we talked about, Warren Buffett has made an investment in Google. So it doesn't seem like that all of it's bubblicious. But, NVIDIA is up there. So again, I think it's a higher volatility ETF. But if you're aligning yourself with those core drivers around AI, this is where you might want to look, but not too much.
Okay. Let's take a quick break. We'll line up some more phone calls. Mike Philbrick, Resolve Asset Management, taking your question today on exchange-traded funds. We're back in just a moment. Stay tuned. Welcome back, and thanks for joining us. Let's go back to the phone lines. Ghulam is on the line in Toronto with a question today for Mike. Hi, Ghulam.
Hi there. Good afternoon to you both. My question is on Bank of Montreal, ZWK and ZWE. I recently put some money into ZWU and ZWB, but my GICs have come up for renewal, and I've got some funds that I can put in. So I thought I'll diversify into ZWK and ZWE. What is your suggestion? Should I do that, or you got an alternative? Thank you so much for your help.
Okay, thank you for the question, Ghulam. So ZWE is the dividend, BMO's high dividend covered call, which is hedged. And ZWK, Mike? ZWK was the first one. ZWE was the BMO Europe high dividend covered call.
Yes. Yeah. So I actually I like the combination, first of all. I think if that's what you're looking for in that area, looking at both Europe and the US makes some sense for sure. But you can see on the chart there, you've got a little bit more persistence, less drawdown with the European high dividend covered call ETF. So I would probably skew a little bit more there. There's been a little bit more strength there, a little bit more diversity in your portfolio. So I kind of like that one a little bit better. But again, we don't know for certain what happens in the future. And I like having that European exposure. We've got a lot of exposure to Canada just through our natural markets, through Canada to the US through our natural markets. So Europe is going to be a little bit more diversifying to the portfolio. So I slant to that one a little bit. But I think that the combination is fine for what the caller's looking for. Nothing wrong with those two picks at all.
Okay.
I don't underestimate Europe, is what I would say, which a lot of people do just by exposure. When you look at exposures in Canadian portfolios, it's usually far underweight.
Okay. Let's get to our next caller, Adam in Toronto, with a question. Hi, Adam.
Hi, good day to you both. Mike, I'm looking for exposure to global utilities with a decent monthly dividend and preferably no leverage. Could I please get your thoughts on HUTL? And do you have another name you might want to combine it with or prefer? Thank you.
Okay, HUTL is utilities play, and I think it's global, equal weight. Is this one you know pretty well at all, Mike?
Yeah, we've actually had this on our recommended list and past picks previously. So I do know pretty well. Again, you're looking at those global utilities, and utilities are a wonderful place to sort of hide money. The way a utility works is pricing is usually governed by, in the regulatory environment. So they respond nicely to interest rates. And as we look at getting interest rate cuts and hopefully some attenuation of those long-term rates, you should see that be a tailwind in the utilities world. Now, writing a little bit of the covered rights on it, these are lower volatility assets. So, the covered writing is less effective, and you have to always remember you're giving up a little bit of upside when you do that. But this is also equal weight, so you're not taking any of those individual risk names. I think the caller's nailed it for what he's looking for. This is actually a really good solution for that, and I don't have any issue. I think that's pretty much as good as it gets, and especially when you want that global side of things.
Okay, let's move on to another caller then. Margaret is in Victoria, BC with a question. Hi, Margaret.
Good morning. Thank you for taking my call. Could you please recommend an ETF or two that would cover the developed world ex North America, please?
Okay, thank you for the question. Outside of North America, and a lot of people are looking more globally, do you find you're getting more calls about that, Mike, as well?
Absolutely. You're definitely seeing that happen a fair bit. Is that I think because of the good performance that we've seen from those international markets, it's been quite a good place to be looking. And the diversification that comes from that, like we just talked about with the previous caller, getting some Europe, getting some Asia in the portfolio. And so for this, I would look at the Vanguard FTSE Developed All Cap ex North America ETF VI. Again, Vanguard with a 22 basis point MER. Dividend yield here is 2.4 or 2-ish%. So, solid performer. You can see there on the chart. It's challenging. It's all-time highs. And I think the caller's right on the money here. Let's get some diversification to equity markets that are outside of North America and let them complement those North American stocks in your portfolio. This outside of North America engine is humming. It is working. We're seeing capital flows in that direction, and we're seeing much more reasonable valuations across the board when you look at that. So when you look into the U.S. and you say, well, how's U.S. large cap looking from a valuation perspective? It's pretty high. But if you dig under the surface and you say, well, what's the multiple? What are the multiples like in U.S. small caps? They're actually pretty reasonable. How about European stocks? Also pretty reasonable. How about Asian stocks? Again, pretty reasonable at average or slightly above average PEs. So you've got some expansion from the value side on these parts of the world, and you're getting the diversification across their business cycles and their currencies. So I really like this approach.
Okay, we're going to take another quick break. We'll line up some more phone calls and some emails from Mike Philbrick. We're back in just a moment. Stay tuned. Welcome back to Market Call. Thank you for joining us today. Let's go to John. He's on the line over Johnny. He's got a question today for Mike. Hi, John.
Hello there. I'm a dividend investor and looking for, obviously, the income, but just as important, the dividend growth. I have a significant investment in SCHD for the U.S. market and then VDY for the Canadian market. SCHD in particular, although it's been flat the last year or so, has pretty significant dividend growth. I was just wondering your opinion on those two ETFs as a strategy.
Okay, thank you for the question. So the first one is a Schwab U.S., which looks at the Dow Jones or tries to track the Dow Jones. And the Canadian one is VDY. Do you like them both? What's your opinion, Mike?
Yeah, these are great go-tos, really. The U.S. large cap dividend stocks that SCHD invests in, they're looking for that strong dividend history with financial strength to make sure those dividends are there. Now, VDY in Canada, it's your large cap, high dividend stocks. Now, you have to remember in Canada, you're going to have that financials exposure and you're going to have that energy exposure. And it's worked wonderfully. As we've talked about over the last 6 months, really that's Canada's real feature right now. As we have this AI boom, the resources required to build those AI data centers and build those energy sources are booming. And that's why Canada's doing so well. So I like both of these. I think, you've got broad diversification. You've got a good dividend yield for both of them. Obviously, in Canada, you've got your Canadian dividends that are eligible for that tax credit. So if this is outside of a registered account, a little bit more tax efficient. You don't quite get that on the U.S. side, but you get the diversification. And I think we're going to see a broadening of the market rally. We've seen a very strong few days here as we've shaken off some of these tech concerns, and you're rotating into these other names. And I think, the broader market probably is due for a little bit of catch up. So I think that this is a nice pairing for what the investor wants to achieve.
Okay, I hope that works for John, and let's move on to our next caller. Sam is in Toronto. Hi, Sam.
Hi. I would like to have your opinion of CIF, CI Global Infrastructure Index. It has a very good run for last 5 years. Do you think you have more growth to come? I would appreciate your opinion. Is it a buy at this price? Thank you.
Okay,
Bye.
Thank you for the question. So CIF iShares at 59.58, a little bit up on the day, and up 16, almost 17% on the year. Pretty good run from sort of that April low. What is your take, Mike?
This is a sector that is benefiting from all of that AI build out that we've talked about. So I think this is a wonderful piece of additional portfolio diversity. Again, the iShares Global Infrastructure Index ETF. So you're talking about the global build out of everything that comes with all of this isn't just AI, by the way, but it's got things like NRG Energy in it, Stantec. So it's got some things that are related to engineering, to energy. And so that's what you're feeling when you're seeing this run. And this is one of those ETFs that's a nice complement to the tech ETFs. We were talking earlier with someone wanted the tech giant ETFs, right? And those types of things. CIF is a lovely complement to those because what you're doing is you're just moving a little bit upstream. So if we're going to build the data centers, we're going to build out all this AI, which, we've had a presidential declaration on a Manhattan Project-like initiative to build out AI through cooperative infrastructure up and down, basically all of the U.S. economy. That's going to take this type of infrastructure build out, and that's a wonderful complement to the technology side. It's the picks and shovels that are going to bring AI into its reality.
Do they tend to be? Sorry to interrupt you. Does it tend to be a less volatile part of that chain? We see the tech stocks, some of them move up and down all the time. When you go further downstream, are those ones sort of a little more stable?
Correct. They are at the moment. So we shouldn't mistake that, because one day, some of these things will have their moment where they start to run into higher valuations. And you may see some of that volatility creep in. At the moment, though, this infrastructure play and those real world assets that are going to provide all the underbelly of the pure tech growth, I think are underappreciated. And that some of them have some nice dividends along with them. So at the moment, yes, but that can change. And I would expect down the track, it will change. But that's when you've got to manage risk, and you'll have to reduce the position at that point.
All right, we are going to take another quick break. Mike will share his new top picks. That's coming up next. Join us tomorrow on Market Call. Brianne Gardner will be with us on the show. She's Senior Wealth Manager at Velocity Investment Partners, Raymond James. She'll be taking your questions on Canadian and U.S. large caps. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Mike. We will start with BMO's equal weight U.S. healthcare ETF, ZUH, on the TSX, obviously anchored around healthcare. Mike, is this one you own? If you do, why? And if you don't, why not?
Well, I don't own this one. And so part of our selection, so at Resolve, we are part of the return stacked group of ETFs and funds. And we manage those funds with using futures. We're a commodity trading advisor. And so we trade across a wide variety of global bond markets, global equity markets, currency markets, and commodity markets. And so where our clients usually own our return stacked ETFs in their portfolios, where we own those underlying exposures via the futures market. And so while we'll own similar exposures at times, we don't often own the individual ETFs, but we do have a really good broad understanding of how these asset classes work together. And most individual clients don't really use futures. So our second pick, as an example, is Canadian bonds. And while in our portfolios we have exposure to Canadian bonds through the 10-year bond futures contract, we don't actually own that particular ETF. So that's why we'll tend not to own the actual specific ETFs, because we're creating those exposures in a different way through our ETFs for the various advisors and individual investors who buy them.
Okay, so let's talk a little bit more about the healthcare ETF you are recommending here and what's under that banner.
Yeah, so this is the equal weight approach to healthcare. So you're avoiding, concentration in mega pharma. So you got pharma and biotech and healthcare services, and healthcare is a lower volatility area. And so this helps with diversifying against the narrow leadership that's in the indexes right now. So it's a little bit of defensive growth. Steady demand is coming from this area. You got strong balance sheets and low economic sensitivity. The kicker is that you've got lots of healthcare innovation coming due to AI, genetics, diagnostics, devices that are going to be run with AI, and the AI-enabled tools and diagnostics that are going to come. So you've got a defensive sector that's going to have a huge benefit from AI at good valuations. So that's why we like ZUH, the BMO Equal Weight U.S. Healthcare ETF.
Okay, let's get to your second pick, which you talked about a little bit, which is the Canadian Government Bond Index ETF, iShares Core Canadian Government Bond. What do you like about this one specifically?
Well, this is the really high quality exposure to Canadian federal and provincial bonds. Lots of liquidity in this. You've got a little bit of duration. So remember, we talked about earlier, if we get a growth shock and things go a little wobbly, your bonds tend to do really well. We've also seen really big cross-border flows coming into Canada, and in particular the Canadian bond market. And this is likely due to Canada's resource exposure. International money is seeing Canada as being a pretty safe place to put their dollars. And so if you've been a little bit overexposed to tech lately and you felt, oh God, since October, I haven't been comfortable with my portfolio, it's time to get your risk right and maybe incorporate a little bit more bonds in the portfolio as a ballast in your portfolio, and also allow you some flexibility to do some rebalancing. And again, bonds finally provide a real yield again. So, this is wonderful to provide that real yield, that ballast, and the flexibility for rebalancing optionality.
Okay, let's get to your third pick, which is SPDR, S&P Biotech ETF. You mentioned biotech would also be in the healthcare ETF that you chose.
Yeah.
Is this one just completely focused on biotech?
Correct. So this one's a little bit more spicy. So we're not adding salt, we're adding cayenne here. Again, though, we've got that equal weight methodology. So we're capturing, early and mid-stage biotech, but not dominated by large incumbents. So you've got some broad exposures. You got gene therapy, you've got rare disease. There was some news out about the curing of cancer, or at least putting cancer in remission for long periods of time, discovered through AI. So you've got a high asymmetry, and when biotech recovers, it recovers faster. And we're seeing that. That chart is showing you the explosive growth. If we went back longer, what you're seeing is we're really just barely at new highs. So there's a lot of opportunity coming in the biotech space, which is, again, a spin-off of that AI accelerating drug discovery. And I think this offers an opportunity for uncorrelated growth with significant upside potential for investors to add to their portfolios if they're looking for a little bit more spice.
Okay, so spicy, but talk to me about stability, because I'm going to ask you the same question I asked with the other sort of AI-related downstream ETFs. Would this one be volatile? Do we not know that yet? Are we not there yet?
This one will be volatile, but again, we're trying to attenuate a bit of that volatility through the equal weight methodology. So we're not trying to get in a cap weighted where we got large exposure to any single one name. Also, these biotech discoveries and advancements seem to be spread across a wide array of companies. So we want to make sure we've got broad exposure because, very few companies will actually make up the vast majority of the returns, and we don't know which ones will do that. So I think that there's this great opportunity for AI to accelerate those discoveries across a broad array of companies. And so we want to take sort of a net approach. We're not going to shoot with a rifle here. We're going to shoot with a shotgun. And those types of discoveries are going to be uncorrelated from the big tech market. And again, that's the other nice thing here. You're adding that growth tip, AI layered over biotech discovery, non-correlated to sort of your big tech. A really nice complementary growth factor for your portfolio.
Got it. All right. Mike Philbrick, sir, thank you for joining us. Appreciate that as always.
Always a pleasure.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.